It's actually kind of startling when you think about it.
What's that?
Well, the statistic that in the US, arguably the richest country, only something like 5% of people actually reach financial independence by age 65.
Wow, only 5%. That's low.
Uh-huh.
Really low.
It really makes you stop and think, what are the other 95% missing? What's the secret sauce, so to speak?
Right. Is there some hidden knowledge,
Hmm.
or is it simpler than that?
Well, that's what we're digging into today. Welcome, everyone, to Book Talk Finance. This is where we take a good look at some really valuable finance books to, well, hopefully unlock some financial wisdom for you.
And today, the book is a bit of a classic in personal finance circles.
It really is. We're talking about the Boglehead's Guide to Investing.
Ah, the Bogleheads, a great choice.
Yeah, and what's interesting is who wrote it. It's not, some Wall Street guru trying to sell you the next hot stock.
Right. It's Taylor Larimore, Mel Lindauer, and Michael LaBeouf. These are basically regular people who retired and then became experts through their own study and, importantly, their own experience. Self-taught, really dedicated investors.
Exactly. And they're huge proponents of the ideas of John C. Bogle.
The Vanguard founder, Jack Bogle. His whole philosophy was about keeping things simple, low cost, and tax efficient for the average person, wasn't it?
Absolutely. He really championed the idea that regular folks could succeed at investing without paying exorbitant fees. And this book, well, it carries that message forward.
And that's where the whole Bogleheads community comes from, right?
Hmm.
He started way back, I think, 1998, just as a forum on Morningstar.
Yeah, just a place for individual investors to swap ideas, help each other out, no hidden agendas.
And it grew into this really supportive online community. You can still find them at diehards.org. It's a fantastic resource if you want straightforward advice.
Definitely worth checking out. And the authors, they're really upfront about their goal in the book. They state it pretty plainly.
What's their core mission then?
Basically, to support Jack Bogle's mission by teaching people, teaching you, how to get the best possible long-term return on your investments. And crucially, they emphasize they have nothing to sell you. No products, no services.
Just the knowledge. That's refreshing, isn't it?
It really is. So in this book talk today, we're going to unpack some of those core principles, the Boglehead's philosophy for building, a genuinely sound financial future.
Sounds good. Where do they start?
Well, they start right at the foundation, choosing a sound financial lifestyle. It's about the choices you make every day.
Okay. Lifestyle choices. Makes sense.
They give 3 examples, kind of like archetypes. First, you've got the borrowers.
Uh-oh. Sounds ominous.
It kind of is. These are the folks, living paycheck to paycheck, often relying heavily on credit cards, always prioritizing today's wants over tomorrow's needs.
So maybe financing a new car they can't quite afford, or a big house with a tiny down payment.
Exactly. Or even, like the book mentions, taking out home equity loans for stuff like luxury cruises. It creates this feeling of having access to money, but it's really just debt.
Yeah, the illusion of free money, as they call it. But it leaves you incredibly vulnerable, doesn't it? One unexpected event, a job loss or something, and it all comes crashing down.
Precisely. The convenience of debt masks that long-term cost. You're essentially paying extra just to have things now.
And that interest just keeps adding up, silently eating away at any potential wealth building.
Then, moving up a step, you have the consumers.
Okay, a bit better than borrowers.
A bit. They're maybe not drowning in credit card debt, but they're still kind of renting their lifestyle, as the book puts it, living paycheck to paycheck, maybe.
So they cover their bills, but there's no real cushion. No emergency fund, no long-term plan.
Right. So again, very susceptible to shocks like illness or job loss and retirement. It might end up being pretty bare bones, relying mostly on, government support.
They might feel like they're doing okay, but they aren't actually building any real security for the long haul. Still vulnerable.
Exactly. Which leads to the ideal they present implicitly. The keepers.
The keepers. Okay, so these are the savers, the builders?
Yes. The ones focused on saving consistently and building their net worth. And this is where they make a really critical distinction
Between
income and net worth. This is huge.
Ah, yes. Super important. Because you can earn a lot, right? A high income. But if you spend it all...
You're not getting anywhere financially. Net worth is the real scorecard.
Absolutely. It's what you own your assets, like savings, investments, maybe your house equity minus what you owe your debts, like mortgages, loans, credit card balances.
That final number, your net worth, that's the true measure of your financial independence, or how far along you are on that path.
And they really hammer this point home. Calculate it. Know your number.
Yeah, they strongly recommend you actually sit down and calculate your net worth at least once a year. It's like giving yourself a financial checkup. See if you're making progress.
It's the baseline. You need to know where you stand before you can plan where you're going.
And once you understand that, their advice gets very practical, especially about debt.
Let me guess. Get rid of high-interest debt first.
You got it. Pay off those credit cards, any other loans with high interest rates before you seriously start investing. It just doesn't make sense otherwise.
The interest you're paying on that debt is likely way higher than any investment return you could realistically expect, especially after taxes. It's like trying to fill a bucket with a hole in it.
Right. They even suggest, cautiously, that if you have home equity, maybe consider a home equity loan to consolidate that high-interest debt because the rate might be lower and potentially tax-deductible.
But that comes with its own risks, of course.
Yeah.
Using your house as collateral.
Oh, definitely. And they warn about the credit card merry-go-round if you really struggle with overspending on cards.
Maybe just cut them up.
Seriously. Sometimes that physical barrier is what's needed. Switch to cash or debit. It forces you to be more mindful.
Take away the temptation, basically.
Oh.
Okay, so manage debt. What's next?
The power of starting early and investing regularly. This is where it gets exciting.
Ah, the magic of compounding.
Exactly. They share this amazing anecdote. A Vanguard shareholder apparently never earned more than $25,000 a year in their life.
Okay. Modest income.
Very. But by investing consistently, starting way back in the mid-70s, they ended up with, wait for it, $1.25 million.
Wow. From that income level, that's incredible.
Isn't it? It just shows it's not necessarily about having a huge salary. It's about discipline and time. Starting early and just keeping at it.
Time is your greatest asset in investing, truly. Letting those returns generate their own returns.
Which leads right into the pay yourself first principle.
A classic for a reason.
It's so simple but so effective. Before you pay rent, buy groceries, anything else, take a portion of your paycheck and put it straight into savings or investments.
Make it automatic if you can. Then you don't even miss it.
Right. The book suggests aiming for at least 10%, but obviously the more you can manage, the faster you'll reach your goals, the earlier you might be able to retire, maybe.
And it flips the script, doesn't it? Instead of saving what's left over after spending, you prioritize saving first.
Precisely. They also make a smart point about the efficiency of saving versus earning more.
How so?
Well, think about it. If you cut your spending by $1, that's a whole dollar you can invest, right?
Yep. $1 saved is $1 available.
But to get an extra dollar to invest from your earnings, you first have to earn maybe $1.30 or $1.40, depending on your tax bracket.
Ah, because of taxes. Good point.
Mm-hmm.
So cutting unnecessary expenses has a direct, amplified impact on your ability to invest.
Exactly. And speaking of easy wins, employer-matched retirement plans.
Oh, yeah. If your employer offers a match, like in a 401k, you absolutely have to contribute enough to get the full match.
It's literally free money. Leaving that on the table is just financially illogical.
It's an immediate 50% or 100% return on your contribution, usually. Unbeatable.
And here's another great tip. Whenever you get a raise or your take-home pay increases.
Don't just spend it all.
Right. Try to channel at least half of that increase directly into your investments. That way your lifestyle improves a bit, but your savings rate jumps significantly.
Avoids that lifestyle creep where your spending just rises to meet your income. Smart.
They use the example of cars buying new versus used. That instant depreciation on a new car is thousands of dollars that could have been invested.
Yeah, those seemingly small choices, repeated over time, add up to huge amounts. It's about being conscious of where the money's going.
Now, they do acknowledge not all debt is inherently bad.
Right, like a mortgage for a home or maybe student loans for education that increases earning potential. If the expected payoff is higher than the borrowing cost and the interest is relatively low.
Exactly. But that high-interest consumer debt, that's the stuff to avoid like the plague.
Got it. So build good habits, save consistently, avoid bad debt. What about where to put the money?
Okay, so now we get into the actual investments. The book gives an overview: stocks, bonds, mutual funds, ETFs.
Exchange-traded funds, yeah.
Yeah.
Similar to mutual funds, but trade like stocks.
Annuities, the whole range. They do kind of signal a preference for mutual funds, and especially index funds for most people, mainly because they offer instant diversification and are easy to access.
Makes sense for a beginner or even many experienced investors. Keep it simple.
They touch on bonds, explaining that key relationship. When interest rates go up, the value of existing bonds generally goes down. and vice versa. Good to understand that risk.
Interest rate risk, yeah. Crucial for bond investors.
And annuities get some attention. They mention fixed annuities guaranteed rate, but often low after the teaser period, and potentially high surrender fees if you need the money early.
Those surrender charges can be brutal. Lock you in for years.
Then immediate annuities, which pay you an income stream for life. Sounds good, but
Usually no inflation protection, right? So your buying power decreases over time. And if you die early, the insurance company might keep a chunk of your principal.
exactly. They do mention that some companies, Vanguard included, offer lower-cost variable annuities, which might be more flexible, but annuities in general can be complex. Need to read the fine print.
Definitely. Understand the fees, the guarantees, the limitations before you commit.
Okay, next big concept. Inflation. The silent thief.
Ah, yes. The reason just stuffing cash under the mattress doesn't work long term.
Right. It's not just about the number of dollars you have. It's about what those dollars can actually buy. Inflation slowly eats away at your purchasing power.
When historically in the U.S. it's averaged, what, 3–4% per year? Doesn't sound like much, but over decades.
It cuts the value of your money significantly, which means your investments need to do more than just preserve your capital.
They need to grow faster than inflation just to maintain your standard living in the future, let alone improve it.
Precisely. Which leads directly into maybe the most central Bogleheads principle: keep costs low.
This is their mantra, isn't it? Costs matter.
A lot. Hugely. They share this shocking stat. Historically, the average actively managed mutual fund took almost 1/3 of the investor's total return for itself in fees and costs.
1/3. That's highway robbery, almost. Think of how much more investors would have had if costs were lower.
It's staggering. And the flip side is low cost is one of the best predictors of future net performance for funds.
Right. You can't reliably predict which manager will outperform, but you can control the fees you pay. Lower fees mean you keep more of whatever return the market provides.
So they strongly advise avoiding load funds, the ones with sales commissions upfront or on the back end.
And favor low-cost index funds instead. Read the prospectus. Understand the expense ratio, the management fee, those 12b1 marketing fees, any other operational costs.
They even mention hidden costs, like transaction costs from funds that trade excessively high turnover. That costs money too.
And watch out for wrap fees, where you might pay an advisor an overall fee, but the underlying funds also have their own fees. Paying twice, essentially.
The takeaway is crystal clear. Minimize costs at every opportunity. Every fraction of a percent saved stays in your pocket, compounding over time.
It's one of the few things you have direct control over as an investor. Powerful stuff.
Okay, so low costs are key. Next up, diversification. Don't put all your eggs in one basket.
Another cornerstone of sensible investing.
They touch on the efficient market theory, or EMT. The basic idea is that market prices already reflect all known information, so trying to consistently pick winning stocks or time the market is, well, probably futile.
Yeah, the argument is that it's incredibly hard, if not impossible, to consistently beat the market through active management or stock picking, especially after costs.
So what's the Boglehead solution?
Index investing. Instead of trying to beat the market, just aim to match it by holding a fund that tracks a broad market index, like the S&P 500 or a total stock market index.
And because these funds just track an index, they don't need expensive managers or analysts, so their costs are typically very low. Ties back to the previous point.
Exactly. Low cost, broad diversification. Matches the market return, which historically has been pretty good over the long term and beats most active managers after fees.
But diversification isn't just about stocks, right? They talk about bonds, too.
Absolutely. Bonds play a crucial role in smoothing out the ride. Stocks can be volatile, bonds tend to be less so.
They provide that safety net, especially when the stock market takes a dive, like in the 2002 downturn example they give. Having bonds cushion the blow significantly.
Right. Depending on your mix of stocks and bonds, your asset allocation, your portfolio would have behaved very differently during that crash.
They even suggest new investors might want to hold more bonds than they think, just for the psychological comfort. Helps you stay invested during rough patches.
Yeah, helps prevent panic selling at the worst possible time. Jack Bogle's rule of thumb, your age in bonds, is often mentioned as a starting point, though it needs adjusting for individual circumstances.
And they mention tools like the Morningstar Style Box to help you see if your stocks are diversified across different company sizes and styles, like growth versus value.
Because just owning lots of funds isn't enough if they all invest in the same type of stocks, right? You need funds that aren't perfectly correlated.
Exactly. Adding investments that move differently helps reduce overall risk. True diversification.
Okay, so diversify properly with stocks and bonds, keep costs low. What pitfalls should investors avoid?
Oh, this is a big one. Performance chasing and market timing. Huge hazards to your wealth.
Chasing last year's winners. Yeah, that rarely ends well.
The book hammers this. Past performance is not a reliable predictor of future results. They cite studies, give examples funds that were stars one year and duds the next.
Like the 44 Wall Street Fund or the Grand Prix Fund examples they use. Top of the heap, then crashed and burned.
So that disclaimer you always hear, past performance is no guarantee of future performance. You actually need to believe it.
It's not just legal boilerplate. It's sound advice.
And then there's market timing, trying to jump in and out of the market based on predictions.
Forget about it. The book basically says it's virtually impossible to do consistently.
The track record is abysmal. Most market timing newsletters underperform the market badly over time. They mention Doug Fabian as a cautionary tale.
Yeah, trying to guess short-term moves is a fool's errand for most people. You're more likely to miss the best days in the market, which is where a lot of the long-term return comes from.
They draw a line between helpers' sources of objective info, like the Bogleheads forum, perhaps, and hustlers just trying to sell you something, often with unrealistic promises.
Be skeptical of infomercials, seminars promising secrets. Even some best-selling books need a critical eye. Discernment is key.
So ignore the noise, stick to your plan. That seems to be the message.
Pretty much. Focus on what you can control. Saving, costs, allocation. Not on predicting the unpredictable.
Which leads perfectly into the final maybe theme. Mastering your investments means mastering your emotions.
Behavioral finance. The psychology of investing. This is so important.
Yeah, they touch on common biases, like loss aversion losses hurt psychologically more than equivalent gains feel good.
Which can make people sell and panic during downturns, locking in losses.
Or the endowment effect, overvaluing what you already own, like maybe having too much stock in the company you work for.
Mental accounting, treating different pots of money differently, even though money is fungible. Anchoring, holding on to a loser, waiting for it to get back to what you paid.
And just general financial negligence, not taking the time to learn these basic principles, all these things can lead to bad decisions.
Absolutely. Acting on hunches, following the herd, listening to hot tips. It's usually a recipe for underperformance.
So the key is to recognize these emotional traps and try to make rational, disciplined decisions based on your long-term plan, not on fear or greed.
Easier said than done sometimes, but crucial. Having a plan helps you stick to it when emotions run high.
Definitely. And the book ends on a really positive, empowering note.
Which is
Basically, you can do this. Sound investing isn't about being a genius or having secret knowledge. It's about consistently applying these sensible principles over time.
discipline, patience, long-term perspective. It's achievable for regular people.
So wrapping up our book talk on the Bogleheads Guide, the big takeaways are really clear, aren't they?
Yeah, I think so. Choose that keeper lifestyle save, build net worth, ditch bad debt.
Start early, invest regularly, pay yourself first, keep those investment costs incredibly low.
Diversify properly between stocks and bonds and within asset classes.
Ignore the noise, forget performance chasing and market timing. It's hazardous.
And manage your emotions. Don't let fear or greed derail your long-term plan.
It's a simple, powerful philosophy. And the Bogleheads community, through diehards.org, continues to champion these ideas.
It's a great place to keep learning and connect with others on the same path.
We definitely recommend checking out diehards.org if you want to explore this more. Lots of great discussions and resources there.
So, maybe a final thought for you listening. What's one small change, just one thing, you could do today or this week to shift yourself a bit more towards that keeper financial lifestyle the Bogleheads talk about?
Could be calculating your net worth for the first time. Could be automating a small investment contribution. Could just be reading a fund prospectus to understand the fees. Something small to get started.
Every journey starts with a single step, right?
Exactly. Well, that's all the time we have for today's book talk. Make sure you subscribe to the channel for more discussions like this, all aimed at helping you take control of your financial future.